The idea with real estate professional status in the short-term rental loophole is that we are going to create losses from real estate, and those losses are going to offset our W-2 income or our business income. But in order to do that, we have to spend a lot of time self-managing the rentals. I think a lot of people get into real estate thinking that it is passive and that it's a great wealth generator tool, and it is a great wealth generator tool, but it's definitely not passive.
Hello, everybody, and welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe that the key to scaling your business and compounding your wealth starts every day with a mindset of stewardship over ownership and applying billionaire principles. Our ultimate goal, to help you scale and compound your wealth so you can give more or all of it away for maximum impact. I'm your host today, Brett Swartz, and in every episode, we feature some of the world's top entrepreneurs, millionaires, and billionaires. They share their principles, values, secrets, and wisdom, providing each of us with the insights we need to reach the next level of success and impact. Hey, I'm excited about our next guest. He is one of the founders of Hall CPA. He's actually an amazing authority when it comes to helping people who are especially in real estate understand all of the nuances with tax advantages. He's a CPA by trade. He is from the North Carolina area. He has over 24 real estate units owned right now, and his areas of focus, again, is tax planning. Please welcome to the show with me, Brandon Hall. Brandon, how are we doing?
Thanks, Brett. I'm happy to be here, man. Excited.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, sure. So back in 2015, I was working at Ernst & Young as a senior associate in the big corporate machine, and did not like that. Wanted to try to figure out how to get out of the corporate world. So I found real estate. I started investing in real estate, found bigger pockets, was asking a bunch of questions about buying and managing rentals. And then I realized that a lot of people were asking tax questions. And at the time, there weren't really many accountants answering those tax questions. So I just started answering tax questions. And it took some time. But eventually people started reaching out, asking if I was taking on clients. And then I kind of had the aha moment of, oh, this is what I can do to get out of the corporate world and create my own life and wealth and all that type of stuff. So I launched my firm in 2016. Today we service about 900 real estate investors across the United States from varying walks of life and varying parts of their journey. So we'll work with the people that are buying their first rental, and we also work with pretty large real estate funds and syndicates. And we'll do their outsourced CFO work, report to their investors, all the taxes. So it's really cool. So we get to see it all. We have a team of 51, I think, in the United States. We've got another 35 or so offshore that help us with a lot of the back office and data entry type stuff. And it's been screaming, man. So it's been a lot of fun. I've got 25 units myself, a bunch of multifamily. We've got a short-term rental that's out of the beach that I self-manage and do not like self-managing. But yeah. So it kind of touched a lot of things, met a lot of really cool people along the way.
Awesome. Yeah, I love it. By the way, you can learn more about Mr. Brandon Hall by going to therealestatecpa.com, therealestatecpa.com. And today we're talking about a cool episode. I think you guys are getting a lot of value out of it because it's not, we're going to geek out a little bit about tax, but a lot of you perhaps have learned or heard about the ability to be a real estate professional and the ability to offset active income. Let's say if your spouse is not working full time and you have rental property that you're owning, and that rental property is producing not only income, but it's also producing tax depreciation loss to offset active income if you're working full time W-2. This is kind of a whole thing. This actual episode, we're not touching on that. We're going to touch on a different one. It's called passive activity netting, and it's maybe the counterbalance to the other one that doesn't involve so much of the active time. So let's just dive right into the secrets of this, Brandon. So for our listeners, so Brandon, what is the number one secret to passive activity netting, and maybe define it and kind of break it down for everybody too?
Yeah, so the biggest benefit about passive activity netting is that you don't have to qualify as a real estate pro, and you don't have to run the short-term rental loophole. And those are the benefit there is that you can do this very passively. You don't have to take time away from your family or your hobbies or your other activities. You don't have to worry about a 10 p.m. phone call, about guests not being able to check in, because you don't have to self-manage. Okay, so the idea with real estate professional status in the short-term rental loophole is that we are going to create losses from real estate, and those losses are going to offset our W-2 income or our business income. But in order to do that, we have to spend a lot of time self-managing the rentals. A lot of high-income earners don't really want to do that on a consistent basis. There might be 1 year that they choose to do it, or 2 years, but year over year over year, in our experience, high-income earners, wealthy individuals don't really want to be in a position where they have to self-manage their portfolio for an extended period of time. So what can you do instead? Well, you can get a little bit more strategic about tax. And we were talking before we pressed record here how, frankly, the concept of passive activity netting is kind of boring. And people don't really click on it, right? That's why you don't see it talked about very much, because it's not an exciting concept, because it's a long-term play. This is a 10, 20, 30-year play. But basically what you do is you say, you know what, I'm not going to be a real estate pro. I'm not going to do the short-term rental thing. I'm just going to buy rentals, and the depreciation is going to create tax losses. Those tax losses are going to be passive, meaning I can't use those passive losses to offset my W-2 income or my business income. But I can invest in activities that produce passive income. Okay. Now, what does that mean? So let's say that I love my hair salon right up the road. Okay. And I've used this example a lot, and I hope one day they actually call me up and they're like, hey, do you want to invest with us? Because you keep shouting us out. But I love my hair salon. They are structured as an LLC, not a corporation, not a C Corp. You can do this with an S Corp or a partnership LLC. You cannot do this with a C Corp. So they're structured as an LLC. If I give them $100K for, let's call it expansion capital, maybe they want to go open up a new store, and they're looking for somebody to for whatever reason, they can't get debt, they're raising capital, and I'm going to be part of that. So I give them $100K. I now have a stake, an equity stake in this hair salon business. I'm not going to participate, though. I don't know how to cut hair. I don't know what the operations look like. I'm just the capital guy, right? They're going to give me an equity stake. They're going to pass profits back to me on an annual basis. And because I'm not participating, I'm not materially participating, the profits that I receive are passive income. So if I receive 10K of profits every single year from my 100K investment, and then I have rentals that are producing tax losses, the rental losses can offset the income from my hair salon investment. We often see this with physicians. There's actually a tax court case, I believe it's Hardy versus Commissioner back in 2012, where this was proven. So the physician took a stake in a surgical center, and at that surgical center, he did some of his surgeries for his medical practice. But aside from doing some of the surgeries in the surgical center, he didn't actually participate in any of the operations of the surgical center. They had a whole management team to do that. So he was a passive equity holder in the surgical center. The surgical center spit off a ton of positive income, which was all passive to him because he was not materially participating, and he used rental losses to offset that income. So that's the passive activity netting, right? So you've got a passive stake in a business producing income, and then you also have rentals that you are not working hard on. You've got a property manager running the day-to-day. They do everything. You have positive NOI, right? We always want to have positive NOI. Don't let the tax tail wag the dog. But at the end of the day, after depreciation, we have a tax loss, and we're expanding this rental portfolio. We're taking stakes in private businesses. And we're receiving income from those private businesses. That's all passive income. We have rentals producing passive losses. The passive losses offset the passive income. You do this for 10, 20, 30 years, like the compounding, it goes really slow at first. But if you continue to do this, that snowball gets bigger and bigger and bigger, and it rolls downhill pretty fast towards the end. And you can end up, and I kid you not, making mid 6 figures or low 7 figures or even mid 7 figures, depending on the types of investments you're making, and not pay taxes on them because you've got that rental portfolio that you've been building along the way as well.
Okay, so make sure I capture that. And by the way, you can learn more about Brandon Hall by going to therealestatecpa.com, therealestatecpa.com. Okay, so a couple things that come to mind, right? So it sounds like just choose to be passive or active, or in this scenario, we're just going to compare passive versus active. In this scenario, the increased cash flow from a business that you're a passive investor in is the higher cash flow, right? And then the ownership of real estate that you have is in maybe it's an active or a passive scenario, right? But really what we're saying is you're hiring out all the management. You're not actually doing any of the stuff, right? Or perhaps you go, look, I don't even go buy the 4 unit or the 10 unit or the 50 unit yourself. Go invest into a bunch of syndication that's producing passive income, right? Where you do literally nothing, right? So I'm not going to do any active ownership of real estate itself. Maybe you can clarify that here in a second. But the idea would be all of the depreciation that's passive is going to offset passive income. So passive depreciation loss is going to offset passive income. It needs to be S corp or an LLC, right? And that would perhaps is the fair summary, or walk me through what I missed.
Yeah, no, that's exactly how it works. And if you are like thinking, well, I don't have any access to private businesses, you might not today, but you'd be surprised at how quickly you can gain connections in the small business world. But at the least, you could be investing in like holdcos that are raising funds to buy up a bunch of small businesses or buy stakes in small businesses. I don't know if Alex Hermosi takes on capital partners, but that's an example, right? It's somebody that is buying stakes in a ton of different businesses. You could invest with them and then your dollars get spread out, but still the profits being passed to you are going to be passive because you're not managing the holdco. So there's a bunch of different ways to kind of skin this cat, but the macro idea here is we have to acquire stakes in activities, businesses that produce positive income. And positive income, I guess, is a double negative, but you get what I'm saying. And then at the same time, we want to be buying rental real estate to produce tax losses, and those tax losses are passive. The income received from these businesses that I'm not materially participating in are also passive, so they can offset each other.
Yeah. So just to clarify, when you say buy real estate, are you encouraging people to buy like that fourplex or that 20 unit themselves and hire the management versus that fourplex or that 20 unit themselves and doing it themselves and getting the 750 hours, right?
Yeah.
And also maybe clarify that, because even if I have a property management, I mean, does that disqualify me as a real estate professional? Walk us through that nuance. Or are you saying the third option is actually don't even own anything yourself? Don't put any of the debt in your name. Don't own it 100% yourself. Go into passive syndications or passive real estate funds. Kind of walk us through those three angles there.
Yeah, so let me start with the latter. You can invest in syndications and funds, and the income or the losses coming back are going to be passive, right? Mm-hmm. So yeah, you can do that too. You don't have to even individually own the rental real estate if you choose not to. That's the beauty of this. You have maximum flexibility as long as you are not participating. Now, let's say you do participate. Let's say you do qualify as a real estate pro, or you're running the short-term rental loophole. You create these large tax losses. They become non-passive. And then you also have this passive business income. Well, non-passive losses will be able to offset the passive business income. That's kind of the beauty of this too. All right. So there's no real issue with participating in any one year and blowing this strategy up, because the non-passive losses from your rental real estate will still be able to be fully utilized since they're non-passive. They get to basically offset all income. But the issue with rental real estate is when the losses are passive. Passive losses cannot offset non-passive income, so they just get suspended and carried forward. You can't utilize them. So this is kind of a way to say, okay, if I don't want to, or if I can't qualify as a real estate pro, then what are my other options? We got to think a little bit more strategically about it. This is where this strategy kind of comes into play. Now, your question about the property manager. If you have a property manager, it doesn't necessarily preclude you from qualifying as a real estate pro, but it definitely makes it harder. The property manager is typically going to be the one that's doing all of the real estate professional status type of work. So the question that the IRS would have for you under audit is, what exactly do you do? And can you prove that you do it? And sometimes when we're helping people, we've been helping people with real estate professional status audits probably over the last 6 to 8 months. They've been cropping up a little bit more frequently. And one of the things that people will try to say is, well, I handle the leasing and the tenant move outs and all this stuff. But then the IRS says, well, give us your property management agreement. And the property management agreement says the property manager does all those things. So you lose. If you're going to be splitting any of the work with the property manager, your contract with them must stipulate that scope of work. You can't just say that I'm doing all these things if it's in the property manager's scope of work. So that's an issue, right? So the property manager is typically going to be doing the day-to-day management, which typically means you're not going to qualify as a real estate pro. But here's where it can get a little bit interesting. If you're, and let's put like splitting the work with the property manager aside for a second. Here's where it can get interesting. Let's say you have 10 rentals, and 2 of them are close to you, to where you live. Maybe they require some rehab work. You're going to self-manage that entire process, and you're going to place the tenants, and you're going to self-manage the tenants. But let's say you also have 8 other rentals that a property manager manages on your behalf. Those 8 other rentals, you're not going to be able to say that you spent time on those rentals because you have a property manager. However, you can make a grouping election to treat all of your rentals as one. And when you make this grouping election, essentially those 2 rentals that you have locally where you do qualify as a real estate pro, assuming you meet the 2 quantitative tests, you will be able to group in the other 8 and also claim real estate professional status on them as well. So you can have a property manager as long as you're figuring out, properties that I self-manage. I'm spending enough time there, and I'm making this grouping election to treat everything as one.
Yeah, it sounds like you've really got to have very clear documentation on not only the property management agreements, but also on the time and energy you're spending at what property for what. And you've got to get that 750 hours. You've got to make it a job, right? And it's got to be legitimate. Otherwise, it's gonna crash, and you're gonna owe all back the tax, and you did it all for nothing. Is that a fair summary?
That's a very fair summary. Yeah.
Yeah. Any other nuances there, Brandon, as far as like making sure that you're dotting your I's, crossing your T's for this, real estate professional status you want to just touch on real fast?
Crossing your T's and dotting your I's with real estate professional status. The key here is to have a time log that you maintain on an ongoing basis. That's the first thing that if you were to be audited, the IRS is going to request, and that is not something that you want to delay in getting to the auditors. Otherwise, the auditors will assume that you created the time log only once you were under audit, and they'll start to pick it apart. The time log must also not exaggerate time. Okay, and what I mean by that is you can't say that it took you an hour to pay a bill or an hour to respond to an email. You can't say that I spent 2 hours a day on emails every single day forever and ever. You can't say that every Saturday I went and worked on this property from 9 to 5. So generalized time is going to be picked apart by the IRS. So you have to be very detailed. You have to leave yourself very detailed notes. That's my biggest recommendation for anybody trying to qualify as a real estate pro. Because if you get audited for this, it's going to be like 3 years later. You're not going to remember what you were doing on a random Saturday or Monday or something. So leave yourself really detailed notes so that you can explain the various time entries to an auditor. And this is very serious stuff because the auditors will simply just throw it out, and then you'll have to go through the appeals process. You'll have to go to tax court, and that means tens of thousands of dollars in professional fees for you. So, you have to be really diligent about this. If you are not a very good record keeper, if you're not somebody that's very organized, I would not recommend doing something like this because these audits are ticking up. It's a heavily litigated piece of the tax code. And if you have high income, you might be a target for these types of audits. To qualify as a real estate pro, you have to spend 750 hours and more time in real estate than anywhere else. That latter test, more time in real estate than anywhere else, throws out everybody with a full-time job or running a business full-time. You're not going to be able to justify or prove to the IRS that you spent more time in real estate than you did at your full-time job. Many people have tried, and everybody has failed. In that 750 hours, too, I know that there's some people that claim that you only have to spend 500 hours of actual participation, and then it could be 250 hours of anything else. I call them fluff or BS hours. And that's just not true. You have to spend 750 hours actually working on your rentals. Like, it has to be actual rental work. If you are a real estate agent, your education hours to maintain your license could qualify. You're talking about like 20 hours a year, not 200 hours of education or listening to podcasts or going to the Bigger Pockets event and stuff like that. So these junk hours, the easy things, The easy hours to log, those are the ones that are going to be thrown out by the IRS, and you're going to be backpedaling through the entire process, losing sleep, and it's probably just not worth it for you. But that's how you qualify as real estate pro. 750 hours and more time in real estate than anywhere else. And you don't just have to be a landlord. You could be a real estate agent full time. That's 2,000 hours in a real property trade or business. You could be a builder. You could be a wholesaler. You could be a flipper. So there's a lot of different things that you could do in real estate aside from just being a landlord.
Okay, very summary. And Brandon Hall, by the way, can learn more about by going to the therealestatecpa.com, therealestatecpa.com. Okay, so let's bring it back full circle here for the back to the passive one, right? So passive activity netting, right? Passive activity netting. And essentially, it's like instead of having to worry about that, log those 750, actually do all the work, right, for being an active real estate professional, right? The idea is just simply, hey, why don't we just take some of the investment instead of reinvesting it back into real estate? Let's go into business investments that are producing higher cash flow, that I can truly be passive, right? Completely be passive on my real estate stuff, whether I'm in syndication or whether I'm just buying my own stuff, but just doing all the management's all the way third party. Because at the end of the day, right, like this whole financial freedom idea, it's not just income to replace our time. I had a client, they were having the W-2 and they went to the mobile home parks, conference, and they started to buy one mobile home park, two, three, they bought five, and they turned, basically let's call it 2 to 3 million into $10 million, right, of a portfolio over about 15 years. And so they achieved the financial freedom with the income coming in, but all of his time and his energy was consumed with these mobile home parks, right? And so for him, I don't know what we're going to call it here, but I guess maybe just time and energy freedom, right? Where or stress freedom, right? To have to deal with, because he found all of a sudden he's working his W-2. Now he can retire, but now he's not really retired. Now he's having another job as managing the managers. In this scenario, he was definitely spending over 750 hours. He was having to go to the properties, go to the parks, all this stuff. And he's going, this is too much. Now he used our service to defer the tax and really get time and energy freedom, right? Not have to do another 1031 into another deal, which is another topic we can touch on. But is that what we're going to call it here? Like, would it be time, energy, and stress freedom? What do you think, Brandon?
Yeah, I think a lot of people get into real estate thinking that it is passive and that it's a great wealth generator tool. And it is a great wealth generator tool, but it's definitely not passive. Our most successful clients, our wealthiest clients at the firm, run their real estate like a business. This is what their business is. They don't have a W-2 job. They don't have a business that they're running. This is their business. And it's actually kind of changed my perspective a little bit on investing in rental real estate. Whenever I go and I'm looking for deals, I always remind myself of my extremely successful clients, and I'm like, these are the guys that I'm competing with, and they're doing this every single day from 7 a.m. to 7 p.m. I'm doing this 1 hour a week, during my lunch break. Who's going to win in that scenario? And so it's kind of changed my perspective on how do you invest in real estate sustainably without having to spend a ton of time managing it. And there are ways to do that, but you're not gonna see the ginormous gains and the ginormous wealth creation that some other people are going to see when they're doing this full time. So I think that if you go into it with that perspective, you can make real estate relatively passive for yourself. I don't think a lot of people do that, though. I think they go in, they start buying the rentals, they self-manage it because they don't want to pay 10% to the property manager. And then they've got 10 of them under their belt and they're like, oh my God, this is taking up all my time. So they liquidate all of them and then they go into like mobile home parks or something else. And they're like, oh, this is still taking up a lot of my time. Now what do I do? And they eventually find, triple net office space or something like that. That's nice and easy. But yeah, it's not as passive as people make it out to be. And the problem with real estate too, that I have personally experienced is, it's not once things are stabilized, they run pretty well, right? It's not a big deal on a day-to-day basis. You might go a whole month or 2 months without really having to spend a lot of time managing it. And then there's just that like Saturday night at 10 p.m. when the crawl space is flooding and you're trying to watch a movie with your wife. And it's just like, that's the time where you're just like, is this even worth it? So I don't know. I have a little bit of a different perspective these days on investing in real estate. Still think it's extremely powerful and it's still something I'm doing, but I'm going in now fully understanding that this is not passive. This is very much an active kind of a side hustle, side business building thing.
I couldn't agree with you more. And what comes to mind here is, especially some of the states that have highly appreciated assets like New York, California, New Jersey, Illinois. But on top of that, they have a lot of increasing regulation, increasing rent control, increasing just tough to do business, right? With owning real estate, right? The landlord is becoming harder and harder to be a landlord. And you look at it and you go, like, there's a client we helped. They exited a $2.5 million apartment complex in Sacramento. And they had two twin daughters, and the twin daughters were about 10 years old. They had them a little bit older in life, and they had done multiple 1031 exchanges to this property. And the property actually was a good location, good tenants, and producing about $120,000 of cash flow. But that exact thing that you just said, he was driving on the weekends, maybe every other weekend or maybe even one weekend a month, but 4 or 5 hours back and forth with traffic to go to the property. Now, he had a full-time property management, right? But there was always just something. And he's looking up and he's going, wow, we've got a couple $1,000,000 here. We've got other money here. He was actually a W-2. He worked as a nurse, so he's retiring from that. And he's going, we want to travel and spend time with our twin daughters before they're 18. We don't want to 1031 and just start over with new toilets, new trash, new liability, right? But we also want to pay that 40% of capital gains tax, depreciation recapture, state of California and federal. And so they used the deferred sales trust, and we were able to increase their NOI from 120,000 to 190. But the biggest thing there was they had all the time freedom that they could imagine. They went into passive multifamily funds. In the meantime, we went to mostly like lending funds because the market was still pretty high at that point. And they didn't have to go into a syndication. A lot of these syndications are hurting right now because people were overpaid, in 1031s, or just overpaid because the market was so hot with low interest rates. So they were able to diversify, put it into money market accounts, dollar cost average now. And now we've seen the market shift, and now we're buying into these syndications that are, down by 20, 30%, some of the values. And in other words, they got time and energy and freedom back on their side without having to do all the work, right? And so, which leads into the next thought here. Like, what would you say is your biggest frustration when it comes to the 1031 exchange, Brandon, and just the whole concept of having to do it yourself, or even worse, you go into these triple net deals that you think are absolute triple net. Even these Walgreens and these CVSs, they're going out, right? Some of the busiest intersections, you think they would stay forever. They're like, no, we're going dark here. Now they guarantee the lease, but how long is that going to last? Like another 5 or 10 years until the lease ends, right? And then now what are you doing? Now you're stuck with the box, right? That maybe the Halloween store will go in for the season. Like, talk about just that whole idea of not diversifying, having to 1031, right? And then having to count on something that maybe not be there when you actually need it the most.
Yeah, I think that the biggest issue that I see with the 1031 exchange, and to be clear, I love 1031 exchanges, so this is not a knock on 1031 exchanges at all. We have a lot of clients that run 1031 exchanges extremely successfully. The biggest issue, though, is the trap that you can fall into with the timing requirements. And what ends up happening is investors feel rushed. And when you feel rushed, it's an emotion. So you make emotional buying decisions, which means that you overpay on the replacement property typically. Like we see brokers every once in a while be like, this person's got a 1031, he's got 1031 exchange money, willing to overpay or willing to come in at a higher price. And it's just like, that doesn't make, I'd rather just pay the taxes at that point. That doesn't make any sense. We also, at our firm, we help our clients execute something called the lazy man's 1031 exchange. So instead of doing a 1031, you effectively get the same thing. And again, not a knock on 1031 exchanges. I love 1031 exchanges, but they're not for everybody. So a lazy man's 1031 exchange is when you buy and sell a property, or I guess you sell and then buy a property, in the same calendar year. And it doesn't matter when you do it. There's no sequencing here. So I could buy a property on January 1st and sell the replacement property 12 months later on December 31st, and I can still execute this lazy man 1031. So here's kind of how it works. When you sell a property, you're going to have depreciation recapture, right? Because your depreciation reduces your basis, your adjusted basis in the property over time. So if I bought a property for $100K and I depreciated it $20K, my adjusted basis is $80,000. And this is, I like to use this example of if I bought a property for $100 and I sold it for $95, most people would go, man, you lost money. But us tax accountants say, yeah, but you depreciated it at $20K. So your adjusted basis is $80. You sold it for $95. You actually have a $15K gain. that you have to pay tax on. And that gain is from depreciation. So it's called depreciation recapture. So let's say that you sell a property, you have gain, but you buy a new property in the same calendar year. You can cost seg that new property. You can create bonus depreciation deductions, which would create tax losses for you. Those tax losses can offset the gain on sale of the property that you sold. And because we're running a cost seg and bonus depreciation, that's why it doesn't matter the sequencing of events. There's no timing requirements as long as it all happens in the same calendar year. So you could buy a property on January 1st, cost seg bonus depreciate it, sell another property in your portfolio December 31st, and the losses from the property that you bought will offset the gain from the property that you sold. Now, it might not be as perfect as a 1031 exchange, but it gets you there without the timing requirements and the hassle.
Yeah, that is the lazy man's 1031 exchange. Yeah, I love those when the deal makes sense, right? My pushback on that would be, and by the way, it does help you. You don't have to worry about the 45-day identification, which is great. It doesn't need to be in the same calendar year. So you know, if you're selling in January, great, you've got a whole 11 and a half months ahead of you. If you're selling in November, you're squeezing, right? So you're still squeezing for time on that. Um, the challenge is, I feel like I think we're seeing it right now, Brandon. Right? It took 3 years from the 2008 kind of real estate crash or economic crash to see real estate values get to the bottom of 2011. And even then, most of commercial real estate actually did pretty well. It was mostly single family houses that was different from this one. This one, it feels like it's more of a commercial real estate correction. And
Mm-hmm.
if the timing, it stays true, it might take, a year, 2, 3 to see the bottom of some of these deals. And so I still think it's it's not perfect, right? None of these strategies are perfect, right? You do the best you can with what you have, but I do think that diversification, liquidity, right, and then getting time on your side to dollar cost average into multiple things that make sense for you, such as I'll give you another example. We just did a $13.5 million exit for a client out of San Diego. Their basis was $4 million, and they sold for 13.5. About 40% of that would have been tax with depreciation recapture, and then the Obamacare and state and federal. Well, for them, we did it right before the market really shifted for interest rates. And so they were able to pay off some debt, get diversified, get on the sidelines. A portion of that went into Bitcoin, right? At 40,000 a coin, right? And so right now we're recording, we're about 65,000 a coin. So they were to diversify tax deferred into Bitcoin. They were to put it into money market account at 5%, T-bills. They were able to put it into a lending fund paying about 10%, essentially having mostly liquid funds, right? And now the market's shifted. Now what are they doing? They're putting back into hotel syndications, multifamily syndications. They're looking to buy land at a discount because they're the developer that likes to buy land, develop car washes and such, and gas stations. And the concept is a new depreciation schedule, which is just the big thing here, right? Everything we've been talking about with cost seg or 1031s, you're looking at the depreciation schedule traveling or accelerating that depreciation, which is going to get recaptured. But what if you could reset the depreciation, right? And so in our strategy, you can sell, defer the tax, and then once the tax is in this deferred sales trust, you can partner with the trust, and that trust can purchase new assets with the new depreciation schedule, whether that be active or passive. And now the way we structure it, you got to have what's called a commercially reasonable way we structure it. So you can get about 80% of the depreciation. So it's not perfect. Again, you don't get the full depreciation set. But this allows you to set a new basis, a new cost basis, and that can help with the tax flow. So I'm curious, right? I imagine you've heard about Delaware Statutory Trust. You probably even heard about the Deferred Sales Trust. People will approach you with you. What are your thoughts on that strategy, that concept? And if it's, let's imagine it's 100% legal. It's had thousands of closes, close to 30-year track record. What are your thoughts on being able to really take tax flow, cash flow, and debt flow and get it in a scenario where you can get a new depreciation schedule and you can invest at any time?
Yeah. It's definitely interesting. I don't know much about deferred sales trust, so I don't know that I can comment on, will the structure be upheld under an audit? But that would definitely be interesting to see.
Yeah, so over 29 audits for those who are listening, all no change audits, close to 30-year track record. And one of the biggest audits was in California for over $125 million transaction. And these are all no change, no findings audits, and which is pretty remarkable if you can imagine. If Brandon or I or any of us got audited, they're going to find something, on that audit to change. These have all been no change, no findings. It's been perfect. If you want to learn more, you go to capitalgainstaxsolutions.com, capitalgainstaxsolutions.com. We also wrote a book on it called Building a Capital Gains Tax Exit Plan. Kind of bring this full circle, though. It could also work for business sales. It can work for cryptocurrency. We were the first to do it with 13.5 million of Bitcoin and Ethereum. And so the 1031 exchange, part of the challenge is the old schedule must travel, but also you have to use it for like-kind investment real estate. I mean, it has to be investment real estate going into like-kind investment real estate, right? And so you're limited, but it doesn't work for primary homes, business sales, commercial stock. Doesn't work for artwork or collectibles. Also doesn't work for less than a year hold. We just did a recent land banking strategy with a client. They bought, two clients bought over $46 million worth of land where they tied it up, Brandon, for let's say $500,000 as a down payment. And then they work with the farmer who has the property and then the national home builder, but they don't actually close on it, right? And we were able to structure short-term ordinary income that would have been ordinary income tax into these deferred sales trusts. And so it's much more flexible than the traditional 1031 exchange. But if you could, let's say exchange Bitcoin at 65,000 a coin into multifamily syndications that have decreased by maybe 20 or 30%, all tax deferred, to me, that's like one way we could help to solve the housing crisis, right? To build more apartment complexes, to by unlocking this capital gains tax to multiply freedom and impact, right? Any last thoughts on that before we go on to the next topic?
I don't think so.
Yeah. So the $84 trillion, right? That's transferring in the next 20 years. With the baby boomers, right? You have 77 million baby boomers in the U.S. alone, and what's about 50% of all net worth is primary homes, commercial real estate, and businesses, right? So just talk about the massive amount of wealth that's transferring, and then being a CPA on the front lines, does it sometimes feel like you're in the reverse Tea Party, and you're working for ways to try to unlock freedom because otherwise, if the money's taxed, it's going to be crushed with the 35 trillion interest.
Yeah. We really haven't seen the silver tsunami that is talked about. We haven't seen it yet, but I do believe it's coming. It's actually encouraged me to start looking at M&A as a service that we can add on to the firm, just to help the transition and the buyouts. I mean, a lot of business owners don't think about a transition until it's time to transition, which at that point is too late. And they end up not getting the dollars that they want, so they stay on a little bit longer and try to squeeze as much out of the business as they can. So I don't know. I mean, we're seeing people start talking about it. Enough to pique my interest to, like I said, add an M&A service line. But aside from that, don't have a huge perspective on that right now.
Awesome. What's lightning round if you're ready?
Sure.
All right, knowing what you know now, if you could go back to your 20-year-old self, what's the one golden nugget and make sure you tell yourself to do?
Pay an extra $20,000 for people. So instead of trying to hire somebody at 70, go out to the market, try to hire somebody at 90. You'll get access to a much bigger talent pool, better talent pool. And those people, even though they only cost you an extra $20K a year, will help you 5X your business and make your life a lot easier.
Awesome. Number one hire that you've made in the last 12 months, and what's the number one hire that you're looking to make in the next 12 months?
So, the number one, I haven't necessarily hired in the last 12 months somebody that's been game change. I mean, don't get me wrong, we hire amazing people. But the number one hire, I would actually say, is the number one promotion internally. I promoted our VP of operations to COO. And he tears it up. It's been absolutely killer. So it's been great. I get to kind of say, this is the direction I want to go. And he goes and figures out the details. And it's awesome.
Fantastic. And then what about the next one? What do you think the next game-changing one would be?
Next game-changing hire is probably going to be, it's either going to be somebody on the M&A side. So somebody that can help us acquire accounting firms. Or it's going to be on the marketing side. Maybe like a strategic CMO, something along those lines.
Awesome. Number one book you've recommended or given the most in the past year?
Number one book that I would recommend, and it's the number one book I always recommend, is How to Win Friends and Influence People by Dale Carnegie. Awesome book, changed my life. I read it back in college, and I reread it once every 2 or 3 years or so.
So good. Next question. What are you most curious about right now?
I think I'm most curious about how to structure acquisitions of accounting firms to be a win-win for me and the target acquiree. I've been speaking with a lot of consultants. I've been speaking with private equity, and there's a lot of different ways to structure deals to make it win-wins. So that's kind of what I'm most curious about. That's probably my next chapter, is next 12 months or so, is really figuring that out.
That's cool. Next question. Number one leadership quote or theme that you strive to live by?
Don't let people steal your time. That's the number. I actually wrote about this in my. I like write notes to my kids. I have a 4.5 and 2.5-year-old, and I've got like a little private journal that I write notes to them on. And this is my most recent one: is don't let people steal your time. So gave them a few tips, but I try to live by that, and I consistently find that I let vendors steal my time. And that's primarily what it is just going through a big implementation and then realizing you didn't ask the right questions at the beginning and could have saved yourself a lot of time had you. So it's just learning those types of things.
Awesome. Last question. And it's kind of the foundation of our podcast, right? Which is practicing a stewardship mindset over ownership, right? And we believe that that's the scaling to not only compounding your business and your wealth, but also making a huge, massive impact beyond just where we're at today. So what's that concept of stewardship over ownership mean to you? And what's something that you really believe in to make a big impact in this world?
I don't know. I've been thinking about this recently. I'm young. I don't know that I really have like a clear direction of stewardship yet. Both of my kids have suffered from febrile seizures, and that's something that I find very interesting. And they're totally fine. And a febrile seizure happens when like your fever spikes up very quickly. It's really only in young kids, and their bodies just can't handle it. So it just kind of shuts down and they reset. But going through it and not knowing what it was the first time was obviously terrifying. So I think if I were to do anything, it would be donating to research that helps discover more about why those exist, and then maybe getting word out. Because once it happened, I connected with a lot of people that this is not like an uncommon thing. Yet it doesn't pop up in really any pre-baby book or here how-tos or anything like that. But it's a very scary thing, and if you've never seen a seizure, which I never did until my daughter had one, it was I didn't know she was choking, I didn't know she was dying, I didn't know what the hell was going on. So that was very scary. So I think doing something along those lines is in my future. But aside from that, I sit on the board of their preschool and help them kind of look at their budget and make decisions. And we recently approved a big furniture refresh, which was great. So very proud of that. Yeah.
Amazing. Brandon Hall, it's been absolutely great. Thank you so much for sharing your wisdom, your expertise on passive activity netting, on the lazy man 1031 exchange, and all things, deferring capital gains taxes and building wealth. I want to encourage you to keep using your gifts and talents you've been given to bless people. We're in the next 18 years will be telling for the country, and we need professionals like you every single day, helping people make wise, legal decisions when it comes to tax and all things, especially real estate, right? If we're going to solve the housing crisis, we've got to figure out ways to unlock capital to help build more houses in a very tax efficient way. So keep doing what you're doing. For our listeners who want to get in touch with you one last time, would you remind them what's the best place for them to find you?
You can go to therealestatecpa.com. That's www.therealestatecpa.com. We've got a ton of resources. We have a podcast. We've got a big button that says get started if you're interested in becoming a client. But thanks so much, Brett, for having me on. I really appreciate it.
Absolutely. And I also want to thank all of our listeners for listening to the episode of the Build to Millions podcast. As always, we believe, most millionaires, they struggle with, and entrepreneurs struggle with scaling from millions to billions. And we keep the key to scaling your business and compounding your wealth and impact starts every day with a mindset of stewardship over ownership and applying billionaire principles. I hope you take this knowledge today and you start applying it, or just go out and reach out to Brandon and hire him to help you apply it, right? This is what he does, especially if you're in real estate and you're looking for an expert who is understanding your world in real estate, not just a general CPA, but a specific real estate CPA. Take advantage today with Mr. Brandon Hall. Appreciate everyone listening, watching. Please subscribe. Please share. This will make a difference for someone. And today, thank you so much. Bye. All right, brother. Thanks.